Now, when a Singapore company makes an investment into an Indian company, it can be either by way of equity shares or either by way of CCDs. Of course, there are other ways, which is debt, preference shares also. But for the current purpose, we are just looking at equity shares and CCD. There is the change, or there is a difference between how the income arising from transfer of equity shares and CCD is taxed. Now, insofar as equity shares are concerned, if the equity shares which are transferred were acquired before 1/4/2017, then the capital gains are basically exempt in India. The right to tax lies with Singapore, and because Singapore does not have any capital gains tax, effectively the total tax on such capital gains is zero. It doesn't matter when you are transferring these shares, the capital gain will be zero. But if the shares were acquired after 31/3/2019, and there is again a differential treatment for shares acquired between 1/4/17 and 31/3/2019, but if shares were acquired after 31/3/2019, then India also has a right to tax the capital gains arising from transfer of these shares. Under the existing treaty, the capital gains arising on transfer of compulsorily convertible debentures are not specifically covered under any of the clauses of the India-Singapore Treaty. And therefore, in many cases, companies do take a stand that the capital gains arising on transfer of such CCDs are exempt from tax. Of course, this is subject to the requirement of substance, having the place of effective management in Singapore, and other treaty conditions like the LOB clause, etc. But if those conditions are satisfied, the case for exemption can be made in point 1 and point 3 above. We are conducting a live webinar where we will be covering other aspects like this, which are relevant in the case of India and Singapore Treaty on various incomes. If you want to register for it, you can click on the link given below in the description and join us live on April 5th. See you there.